The month of March has seen absolute devastation in the markets, and with no end in sight with the war in Iran, we might see markets push down even more. Over the past month, VU is down 7.6%. Remember, VU is the Vanguard index that tracks the S&P 500, and we see four of the Magnificent Seven stocks under 7.6%. So we have Microsoft down 9%, Tesla down 10%, Google down 12%, and Meta down almost 19%, especially after following that lawsuit in California and New Mexico, and probably more lawsuits to come. The ones that are doing a little bit better than VU, Apple, NVDA, and Amazon, they're all about 5 to 6% down, but they're still down in the past month. If we zoom out to the past 3 months, we see basically the same picture. Everything's down. However, the best performer of all 8 of these tickers is VU. VU down only 8%, and every single one of the Mag 7 down in the past 3 months under VU. And we zoom out to the past 5 years and we see a much different story. We see VU toward the bottom. So in the past 5 years, VU is up 60%. Microsoft only up 51%. Amazon surprisingly only up 31%. But Tesla, Meta, Apple, Google, and NVIDIA all outperforming the market in a 5-year span. And that is what we do here at Interflame Finance. We are in it for the long run. We are not short-term traders. We don't swing trade. We don't day trade. We are long-term investors into quality companies. So in this video, what we're going to look at is the state of the Magnificent Seven heading into April. We are going to look at the Interflame growth scores and 5-year performance of these 7 companies. We have new safety metrics that we're going to feature. This is the first video where we're featuring new safety metrics, and therefore we have new Interflame Finance safety scores. I'll post a video in the coming days explaining what metrics were changed and why we decided to change them. Then we're going to look at the Interflame Finance intrinsic values of these companies, and we're going to compare those with analysts' expectations on Wall Street. And then finally, we would look at if we wanted to invest a $1,000 investment into these 7 companies here at Interflame Finance, how would we do so? Now, the first company that we have here is Apple. Apple has a PEG ratio of 2.6, which is not looking too good. We typically like that to be below 2. Below 1 is much, much better. However, Apple is a gigantic company. It is one of the biggest market caps in the entire world. And so they've probably done a lot of their growing. We don't expect a PEG ratio to be too incredibly large there. Return on equity and invested capital, some of the best numbers of all these companies. Free cash flow yield at a 3.4%. And we have 5-year revenue growth expected to be 7.8% every year for the next 5 years, and 5-year EPS growth expected to be about 13% every year for the next 5 years. If you were to buy Apple today, if they can execute on this growth, you would get it at a PE ratio of 17.3 in 5 years based on today's growth metrics. Now, in the month of March, we've basically been down about 8.8% in Apple. That stock has been beaten down. However, we saw that a lot of those other companies were beaten down a lot more, so Apple is one of the quote-unquote safer companies of these 7 companies. Next up is Amazon. Nothing's bolded in Amazon, so there are other companies that have better metrics than Amazon, but the PEG ratio coming at 1.3 is respectable. Debt to equity looking very nice at 0.4. We want that to be as low as possible. Return on equity and invested capital between 14 and 22%. Profit margins, okay, at about 11%. Revenue growth is expected to be about 12% every single year. 5-year EPS growth about 18%. Free cash flow yield, we'd like to see that much higher. We typically like for mature companies 7% or higher. 0.4% just ain't cutting it. And a 5-year forward PE coming in at just a 12. Amazon not looking too bad in the past month. Other stocks are down much more. Amazon only down about 4% in that time. Next up is Google with a debt to equity of 0.2, which really stands out. PEG ratio at 1.6. Again, we'd like to see that a little bit lower. Forward PE at a 22 and 5-year forward PE coming in at a 13. So looking good for Google in those regards. You could get Google today at 13 times forward earnings based on the next 5 years. Now, Google is one of the companies that has been beaten down more in the past month, down about 11% in that time. So Meta has some very interesting numbers going for it. The PEG ratio is under 1 like we like to see. It's at 0.8. Forward PE just at a 16.3. 5-year forward PE coming in at a 9.3. So those are great numbers. The free cash flow yield of all 7 of these companies is the best at 3.5%. So we're not going to crack that 7% threshold that we like, but these are large, high growth companies. And so we don't expect it to get in the 6 or 7% range, really. So Meta has the best free cash flow yield of all these companies, expected to grow their bottom line 19% every year for the next 5 years. However, like we said, with that lawsuit and probably other lawsuits coming down the pipe, Meta is down 20% in the past month. The profit margins for Microsoft are a very healthy 39%. The PEG ratio is a decent, respectable 1.3. Forward PE 19.6, but a 5-year forward PE coming in at 9.5 for Microsoft. That is looking like, as far as valuations are concerned, a steal deal. They're expected to grow their top and bottom lines between 16 and 19% every year for the next 5 years. And Microsoft is one of the stocks that's been beaten down 11%. I'd like to zoom out for Microsoft because we see that in the past 3 months, they're actually down 27%. Over the past year, they are not up at all. They're actually down 8.5%. And in the past 5 years, they're actually underperforming the market at just 51% growth in that time. So Microsoft, if it can rebound, if it can get back on its feet, this is a possible high growth play in terms of the company's fundamentals, but also hopefully in terms of the stock price as well. Now, if you are a regular on this channel, you know that we love NVIDIA. The numbers for NVIDIA are consistently awesome. PEG ratio at 0.5, forward PE at 17.6, the best 5-year forward PE at 9.1. Debt to equity, they have no debt on the books. That's very attractive for these very uncertain economic times. You don't want companies to have a lot of debt. Return on equity and invested capital around the 100% mark. Profit margins at 56%. 5-year revenue growth at 26%. 5-year EPS growth every year, 30.5% for the next 5 years. That is just phenomenal for NVIDIA. But NVIDIA is down about 9.4% in the past month. Year to date, down 10%. Past 3 months, down 12%. So NVIDIA, one of the greatest growth stories in history, being beaten down double-digit percent in the past 3 months. Possible buy on our list. We will see the intrinsic values in a bit. And finally, we have Tesla. PEG ratio at 4.1. That's more than double what we want it to be. However, they have very little debt to equity, so that's nice to see at 0.2. But that forward PE coming in at a 155 is just way too high for our liking. And the 5-year forward PE still at a 51, way too high for our liking as well. And that's if they can execute on 45.7% growth every year for the next 5 years. Seems a little optimistic, seems possibly a little unrealistic, but with Tesla, you never know. They always tend to surprise investors. And in the past month, Tesla also down double digits, down 11.4%. So for those of you new to this channel, what we like to do is score these companies based on these metrics from -10 to +10, with -10 being absolute garbage company, +10 being the perfect company. And at the very bottom for growth is Tesla coming in at a -2, and that is based primarily on their very sky-high valuations with a forward PE at 155.7. Amazon coming in next at 4.3. Apple coming in at 4.5. We think that Apple has done a lot of its growing in the past 20, 30 years. Now, while 0 is a score that's right in the middle, it's neutral. We like scores to be 5 or higher. We want to make sure that we're buying quality companies. And Google is the first company to come in above 5 at a 5.7 for growth, followed by Microsoft at a very respectable 7.5. We have Meta coming in with a 7.9 and NVIDIA very high with an 8.5 for growth. Those are very nice numbers that we like to see. So growth is very nice. We want our positions to grow over time, but we also want to bake in a little bit of safety. Recessions can come at any time. Black swan events can come at any time. We want to make sure that we have companies that are not just going to grow, but they're not going to go out of business. They're not going to go bankrupt if we own these companies. We don't want our stock price to go to 0. So we're going to get into some safety metrics, and these are new on this channel. But before we get into that, we'd like to ask if you're getting anything out of this video so far, please consider liking it. That would really help out the channel. And if you want to consider subscribing to this channel, you can keep coming back for more safety metrics, growth metrics, valuations, and scoring of some of your favorite stocks. Now, first up is Apple. As usual, in our safety scores, we're looking at the PE ratio, currently at a 31.5, but we're also now comparing it to their historical 5-year PE at 30.1. So the PE is currently higher than it's been historically. That's not a good sign for Apple in the moment, but they're so close that it's not too terrible. Debt to equity coming in at 0.1. I'm sorry, at a 1 even. So they have the exact same amount of debt that they have to equity. Interest coverage, we could not find reliable data on that. So we are excluding interest coverage from the score for Apple and for all companies to keep everything even. They do have a very small dividend yield at 0.4%. However, they are growing those dividends. They've grown them for 14 consecutive years. And with a payout ratio of only 13.4%, we would expect them to continue growing their dividends into the future. Their beta is 1.1. We want that to be under 1, mainly because if there's a huge violent swing down in the stock market, we don't want our companies to go down even more. So beta is kind of like the ratio where at a 1.1, this would mean that if the stock market went down 1%, Apple will go down 1.1%, and we don't want that to happen, obviously, when it comes to safety. And finally, return on assets, very healthy, 28.5%. Next up is Amazon with a PE ratio considerably lower than their historical 5-year PE ratio. So that is very good to see for Amazon. We have interest coverage at 35.2. That basically means that they can cover their interest expenses 35 times over with their current EBIT. So that's earnings before interest and taxes. We have debt to equity at 0.4. We've already seen that. That's very nice. And they have one of the lowest price to sales of all of these companies. Google with a PE ratio that is just slightly higher than their historical 5-year PE ratio at 24. So that's a little concerning for us. However, their beta also at a 1.1, so not too far off from that 1 mark, but their payout ratio, 7.7% on a just 2-year growing dividend. So this is a new dividend payer, just a 0.3%. So you're not getting a huge cash stream from your Google investments, but their payout ratio is so low that we would expect them to continue growing these dividends over time. And their interest coverage is just a shocking 175.3. That's nice to see for Google. Meta, PE ratio 22.4, just slightly under their historical at 23. Their price to sales ratio is 6.6. That is the second best of all 7 of these companies. Their debt to equity is 0.4. Interest coverage 71.5. That's very nice to see. Free cash flow yield, the best of all these companies, as we already saw, at 3.5%. And Meta is also a relatively new dividend payer, only a 0.4% dividend yield. They've grown their dividends for 2 consecutive years. Payout ratio only 8.9%. They'll probably continue paying and growing those dividends out into the future. Now, Microsoft with a PE ratio very well under their historical 5-year PE ratio, 22 versus 34. That's very nice to see. Interest coverage at 53. That gives us a lot of comfort when we own the stock. Free cash flow yield at 2.9%. Their dividend yield is at a 1% even. They've grown those dividends for 20 consecutive years. And with a very small payout ratio of 23.3, we would expect Microsoft to continue those dividend payments and growing those dividends as well. Beta also coming in at a 1.1. NVIDIA's PE ratio, shockingly half of what it's been historically at a 63.4. So very, very nice, very encouraging for investing into NVIDIA. Return on assets, 63%. Their payout ratio is just a very small 0.8%. They do pay a dividend, but it doesn't even register to 1 decimal place. So they do offer a very small dividend yield. They've grown those dividends for 2 consecutive years. However, their beta is a 2.4. So if the stock market were to go down 10%, NVIDIA would go down about 24%. So that would be a huge drop in NVIDIA if there's significant volatility in the market. However, their interest coverage is a 503.4. So that means that they would be able to pay their interest obligations 503 times over. Debt to equity coming in at 0.1. That's the smallest of all these companies. And finally, Tesla, their PE ratio is currently 347 with a historical 5-year forward PE at 96. So we are 3.5 times larger in valuations than we have been historically for Tesla. Not looking too good. Their return on assets, not looking too good. Their beta close to 2. Free cash flow yield very low. Interest coverage at a 12.9, which is good, but we'd like to see that higher. So Tesla not looking too safe either. So safety scores also range between -10 and +10. And so Tesla coming in at the lowest at a -1.5. NVIDIA coming in for safety at a 3.7, probably due in large part to that beta of 2.4. Apple coming in tied with NVIDIA at a 3.7. Google has a safety score above 5. It's at a 5.7. We have Amazon coming in at a 6.1 for safety. Meta coming in at a 6.3. And the top of the leaderboard for safety is Microsoft, the reliable dividend payer and dividend grower for 20 consecutive years. 7.7 safety score for Microsoft. So our Inner Flame Finance scoring method lets us know what are the best companies and who's better than who. However, we want to make sure that if we were to invest in these companies, we want to get them at a good price. Remember, Warren Buffett said, price is what you pay, but value is what you get. So what we have here is the intrinsic value worksheet that we've built out. If you go down to the description of this video, you will see 4 different intrinsic value calculator links. We show you how to compute the PE ratios model, the dividend discount model, the discounted cash flow, and the Graham valuation model. So what we do is we compute all 4 as appropriate. So Google doesn't really pay a high dividend, so we do exclude the dividend discount model for it and basically all 7 of these companies in this video. But what we do is we compute the other three intrinsic value calculations, we average them, and that gives us our intrinsic value. Now, what we can see here for Google is that we believe that it should be trading for 276. The current stock price is 274, so that only gives us a $2 margin of safety. That's a 0.7% margin of safety. Probably not something that we're too confident in. We like safety. Another thing that we did change in recent days is that the perpetual growth rate, we've actually lowered that down to 2.5%. It was 3% earlier. We've lowered that down to 2.5%. And that's just to bake in more cautious and a little bit more conservatism in our estimates for these companies. We don't want sky high intrinsic values. We don't want to be overly optimistic. We want to be cautious and hopefully just pleasantly surprised in the end. So again, check out the description of this video, find those 4 links and build out your own intrinsic value calculators so that you can do those for any of these 7 companies or any companies that you want. Being able to compute the intrinsic value of any company is an important, valuable tool for any investor's toolbox. So check out the description below. So now we're going to look at the growth and safety scores and average them. We are going to do a weighted average where we're going to value growth more than safety. We can see that here by these numbers of 7 versus 3. So growth is going to get a weight of 7. Safety is going to get a weight of 3. We're also going to compute the intrinsic value of these companies. So for Tesla, a $96 price target for Tesla. It's currently trading for $362. So that means that you are not getting any margin of safety for Tesla based on our approximations and calculations. As a matter of fact, you are paying a 277% premium for Tesla. Now, if you think our price target of $96 per share is low, there are analysts out there that say that it should actually be trading for $25 per share. So we're not that bearish on this company. The average estimate coming in at about $400 per share, median 471. So the average consensus on Wall Street is that Tesla's probably going to go up between 10 and 30% in the next year. The high estimate coming in at $600 per share, that would be about a 66% increase in the stock price. The overall consensus is also hold. There are 7 analysts that say that Tesla is a strong buy, 9 saying buy, 10 say hold, 3 analysts are saying sell, and there's actually 4 in the strong sell camp. And so Tesla is all over the place. It's always been all over the place. A lot of mixed emotions when it comes to this company. They have outperformed. They've grown quite a bit in the past 10 to 15 years. But in the next 10 to 15 years, past performance is not an indicator of what's going to happen in the future. So Tesla right now is looking like it's at the very least a hold, possibly even a sell. Apple has an average Interflame Finance score of 4.3. It's currently trading for 249. We believe it should be trading for 190. That would imply a 31% premium for Apple. Now, our 190 price target is actually lower than the lowest analyst on Wall Street. The lowest analyst coming in at $200 per share. That would be a 19.6% drop in the stock price. And the most bullish analyst coming in with a 350 price target, that would be about a 41% increase. But really, the average consensus on Wall Street is that you probably have about 20 to 23% growth in Apple, going between $296 and $305 per share. The overall consensus is that Apple is a buy. There are 10 analysts that say that this is a strong buy, 8 say buy, 8 say hold, 2 are saying sell, but nobody's in the strong sell camp for Apple. Amazon is the first company coming up with a positive margin of safety, average score of 4.8 and a 12% margin of safety. Current stock price is $199. We think that Amazon should be trading for $227. Now, $227 is in the lower end, but it's within the spread of what analysts expect over the next year. The average consensus on Wall Street is that it's probably going to go up about 40 to 43% within the next year. The most bullish analysts coming in with a 325 price target, that would be a 63% increase in Amazon. But there is a bear or two out there for Amazon saying that it's going to drop down to 175. That would be a 12% drop. However, given those mixed results, we see that overall the consensus is that Amazon is a strong buy. There are 20 analysts that say strong buy, 23 say buy, 2 say hold, nobody says sell, and nobody says strong sell for Amazon. Now, fourth on this list is Google. They have an average score of 5.7, and that indicates that it's above our 5% mark, so therefore it's probably a very strong company that we want to invest in. However, this is a great example of, yes, Google is a phenomenal company. However, they're trading at fair value. Current stock price is $274. We think that they should be trading for $276. That just gives us a very small 1% margin of safety. So that means that we have to be spot on and exact with our estimates in order to make any money. And if we make any money, it's only going to be $2. So that's not a lot of room for growth. That's not a lot of margin of safety. It doesn't give us a lot of comfort. So we like that margin of safety to usually be 20% or higher. Now, Wall Street disagrees. We say 276 for Google, and the average consensus is about 350 to 370 per share. That's between a 28 and 35% increase in the stock price over the next year. There is an analyst out there saying 420. That would be a 53% increase in the stock price. But Google also has its bears, where the low estimate's coming in at 190 per share. That would be about a 31% drop in the stock price. Overall, the consensus is strong buy, with 20 analysts saying strong buy, 20 saying buy, 5 saying hold. Nobody says sell, and nobody says strong sell for Google. And as always, NVIDIA coming in strong with an average score of 7.1. The intrinsic value is $240 per share, according to our estimates. Current stock price is 168. That would imply a 30% margin of safety for this behemoth. And what we said was 240, and that's almost in line with the average consensus on Wall Street, just a tick below. The average consensus is 266 per share. That would be about a 58 to 59% increase in the stock price. There are analysts out there that say that NVIDIA is going to more than double within the next year, saying it's a $360 stock. That would be a 115% increase in the stock price. And there is a bear or two out there also for NVIDIA saying that the stock price is going to drop to $100 per share. That would be a 40% decrease in NVIDIA. Overall, though, strong buy for this company. There's one strong sell coming in from the analysts. There are no sells. There's one hold. There's 15 buys and 21 strong buys for NVIDIA. The next highest score is Meta with a 7.4 and a margin of safety of 36%. So we believe at Interflame Finance that this is an $821 per share company, and we see that that is basically in line with the average consensus on Wall Street, going up about 60% in the next year. Even the low analysts coming in with a $645 price target. That's a 23% increase on the bear case. The bull case coming in at 1144, that would be a 118% increase in this company. Meta coming in overall strong buy, with nobody saying strong sell, nobody saying sell. 4 say hold, 18 say buy, and 20 say strong buy for the Facebook, Instagram, and WhatsApp owner. And finally, at the top of the leaderboard is Microsoft, the best overall company with an average score of 7.6. They are currently trading for $357 after that beatdown over the past month. We believe that Microsoft should be trading for $508 per share. That would give us a 30% margin of safety for this company. Now, 508 is lower than the average. The overall average consensus is just a tick under $600 per share. That would be about a 67 to 68% increase in the stock price. High estimate coming in almost at a doubling at $675 per share. And even the low analyst coming in with a 392 price target, that would be about a 10% increase in the stock price. Overall, Microsoft comes in as a strong buy, with nobody saying strong sell or sell. 3 say hold, 18 analysts are saying buy, and 12 analysts are saying strong buy. So drop a comment down in the comment section. What do you think of these 7 companies? What do you think of these intrinsic values? Are you more bearish or are you more bullish on some of these companies? Do you agree or disagree with these margins of safety? Now, this would be a good place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your personal portfolio. That is a personal decision for you to make. Always do your own research and always do your own due diligence before making any investment decision, and always consult with a licensed professional. That being said, how would we invest a hypothetical $1,000 here at Interflame Finance if we had to invest in all 7 of these companies? Well, Tesla wouldn't get anything. We think that Tesla should be trading for $96 per share. That means that we would consider buying this company if it ever got down to $82 per share, and we would buy much more heavily at a 35% discount at $62 per share. Now, Tesla is basically a meme stock at this point. There's a lot of retail investors that believe in this company. They're propping it up. A lot of institutional buyers out there as well. So is Tesla ever going to get down to $96 per share? But right now, we are not interested in buying or holding any Tesla. Same thing with Apple. Now, they have a decent score at 4.3, but their margin of safety is a negative 31%. We do not want to pay a premium for any company. So even though it's a solid company, we would wait till it got down to maybe the 162 range. That would be a 15% discount in the company, and we would consider buying much more heavily at $124. That would be a 35% discount. The first company that we would consider buying is Amazon. They do have a decent score of 4.8, margin of safety at 12%. That gives us a $77 purchase, about a 7.7% of our capital going toward Amazon. If we wanted a 15% discount, we would buy at 193. And if we wanted to guarantee a 35% discount of its intrinsic value, we would buy much more heavily at 148. Now, Google is basically priced fairly. It's an average score of 5.7. That's great, but they're basically trading for what they're worth. And so maybe you're going to get a little bit of a discount. We do want to invest a little tiny bit. So not even 1%. We will put 0.4% or just $4 into Google. No surprise, NVIDIA is going to get a huge chunk of this $1,000, $278 or 27.8%, with their very solid average score of 7.1 and their margin of safety of 30%. We will put quite a bit of capital. They are trading at a more than 15% discount. They are under 204. And if they ever got down to 156 or lower, we would consider buying NVIDIA much more heavily. Next up is Meta, also with a great score and a great margin of safety, 36% margin of safety. Meta is currently trading for their 15% discount under 698 and under their 35% discount of 534. So Meta seems to be screaming buy across the board. We would purchase 34.8% of our capital, or $348 over $1,000 into Meta. And finally, Microsoft will get the rest of it at 293. They're currently trading at that 30% margin of safety. And with the best score, that really props up how much we would invest, about 29.3%. They're currently trading at a more than 15% discount below $432. And it's getting so close to that 330 mark, possibly consider buying much more heavily if it ever got below 330. So there you have it, folks. That's our update on the Mag 7 in the month of March. It's been a brutal March of 2026. We'll see what April holds. There's a lot of uncertainty out there. There's a lot of fear, and so stocks are being beaten down. But if you are a long-term investor, this might be the time to capitalize on that fear and purchase some great companies at discount prices. And again, if you got anything out of this video, please consider liking. That would really help out this channel. Please consider subscribing to this channel so you can keep coming back for more scores, analysis, and intrinsic values of some of your favorite companies. And if you could help us grow out this channel by telling your friends, telling your family, and telling your mother-in-law all about the Inner Flame Finance scoring methodology, that would be awesome. We love serving you. We love making these videos. We love hearing from you in the comments. So please feel free to drop a comment down below. Thanks for watching, and we'll see you in the next video.